Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. There are many people every day who make the switch from retail methods of analysis, such as support and resistance and trend lines, to more institutional concepts. And I'm using the term institutional as a very big umbrella term. However, there are two things that I have observed when people make the switch. One being how complicated people make these concepts for themselves, and the complication is only in their mind, which results in inevitable struggle for them to be able to understand and actually utilize these concepts properly. And the second thing being how a lot of quote-unquote institutional traders talk down on retail methods of analysis, not knowing the similarities and not knowing that different schools of thought actually share a lot of points and share a lot of beliefs. Is just looking at them from slightly different angles that makes one school of thought or one strategy maybe a little bit more profitable than the other one. So in today's video, I'll be talking about one very commonly practiced method of analysis, the similarities of it to more advanced concepts, and how majority may lose using this concept, but we can use them in our favor with slightly more advanced concepts for our analysis to be able to not only have a higher profitability rate, but have better risk to rewards. So let's go ahead and jump straight into it. The concept that we are going to be speaking about in today's video is head and shoulder pattern. I know majority of the people watching this video know exactly what head and shoulder formation is, but I'm still gonna go through it very quickly to make sure that we are all on the same page and make sure that everyone has a refresher in their mind about what head and shoulder patterns exactly are. Now, head and shoulder pattern is technically a trend reversal formation, where whenever you see, for example, a continuous bullish trend, you expect at the top of this trend to form a head and shoulder formation and then get a reversal. Vice versa, if it's a bearish trend where the market is continuously declining, we'd expect to see some type of a head and shoulder for this trend to actually reverse. But what is head and shoulder and what does it actually look like? Generally speaking, it's literally in the name. This is a formation that will form a left shoulder, a head, and a right shoulder. Generally speaking, it's about how as the market is trending from that low to higher low, the higher high, eventually we will get some type of a trend reversal by maybe creating another higher low or even a lower low, which I'm going to go through a little bit later. But instead of then breaking past the previous high, it'll create a lower high, and from there the market starts to decline. So in an actual trending market, what the head and shoulder pattern will actually look like, it will be continuous bullish trend, low, high, higher, low, higher, high, and continuous higher lows and higher highs, until eventually we start to get some type of a trend reversal and we will move into the bearish trend. And when you look at the top of this trend reversal, you will get a left shoulder, head, right shoulder. So that's where this head and shoulder formation comes from. And you can actually have the inverted head and shoulder pattern as well, where in a way it started off as a bearish trend where we started to decline, continuously trending lower and lower. And as the market is reversing and turning into a bullish trend, it turns into forming this inverted left shoulder, head, right shoulder, and eventually resulting in the market reversing. Now, there are different ways that people have been taught on how to actually trade the head and shoulder formation, but one of the most common practices for head and shoulder formation is whenever you see this type of formation in the market, what you can do is you can work with the neckline, and a break of that neckline will result in the market going in your desired direction. Now, what is the neckline? The neckline is simply the line connecting the lowest point between the left shoulder and the head to the lowest point between the head and the right shoulder. That's the easiest way to describe what a neckline is. So if I go ahead and put this line in, we can have a look at that as our neckline. And one of the most common practices is as we start to decline more and more, once it breaks the neckline, that's when we will look at the head and shoulder as valid, and you can wait for some type of a pullback, maybe some break and retest scenarios or some Fibonacci levels or whatever it may be, to trade it to the downside. Now, over time, more and more people have gotten to use head and shoulder formations, and they have developed a little bit more risky way of actually trading this, which is wanting to take the trade from the high of the right shoulder. So whenever they see the left shoulder and the head created, they think to themselves, oh, do you know what? I can go ahead and put a Fibonacci in, and maybe at the golden pocket, I can go ahead and sell this to the downside, or maybe there's some type of a previous reversal zone over there, whatever it may be, they will look to trade that to the downside. What is not so commonly practiced when it comes to head and shoulders is exactly what it was designed for, which is market structure. Head and shoulder was simply designed for people to be able to understand market structure a little bit easier. However, as it started to be used more and more, a lot of different methodologies to actually use and trade head and shoulders started to appear from nowhere, and people started to use the head and shoulder the wrong way. Generally speaking, what the head and shoulder refers to is simply a break of structure. So as we are trending higher and higher, we will tend to see some elements of break of previous structure points to the downside, and that is what creates the head and shoulder formation. Left shoulder, head, right shoulder. In some of the more advanced practices of head and shoulder, what's said is only trade the head and shoulder formation if we create a new low before we create the right shoulder. So in a way, in this specific practice, it's actually expected for the market to break below the previous major structure point and then come up and create the right shoulder. And this seems to be some of the more consistent ways to trade head and shoulder formations. But if you have been trading head and shoulders, you would agree with me when I say it's a little bit hit and miss. You're not necessarily able to trade just based on head and shoulders and find out true market direction just based on head and shoulders. So let's have a look at a few chart examples of head and shoulders and what they actually are. This is Euro USD on the 4-hour time frame, but I'm going to switch between a few different time frames to be able to actually show this to the best of my abilities. So let's have a look at this first inverted head and shoulder scenario, where in a way you can see the market is declining and declining. In a way it looks like it's created a left shoulder, created this head, and now has created this right shoulder. It depends on the actual practices of how you are trading head and shoulders. For example, if you were taking into account market structure, then perhaps you would have been able to identify this as some type of a break of structure to the upside, some type of a pullback, and you may have actually been able to trade this to the upside from there. But the more common practice is when you want to draw the neckline. And remember what we said, the neckline is a line connecting the lowest point, in this case it's the highest point as we are looking at the inverted head and shoulder, in between the left shoulder and the head, and in between the head and the right shoulder. So when you connect these 2 points together, you'll get a line, and upon a break of that neckline, then you would expect to take certain trades. Now the issue with this is, even if you waited until the break of that neckline, the question is, where would you have actually entered? Would you have been able to trade this on a break and retest of that neckline? Because this is a method that a lot of people use, and if you did so, then in this case you would have lost. Maybe you were going based on some previous zones of support as this started to trend higher. Either way, it looks as though even if you were able to take some trades, it wouldn't have been long-lived. Maybe you would have been able to hit some, shorter term scalp take profits. However, chances are you would have been caught out when this reversed. You would have either hit break even or you would have hit stop loss. So this is now one of the reasons why we got to study head and shoulders in a little bit more detail and understand the market behavior behind it properly if you want to continue to use it. Let's jump on the hourly time frame and we can have a look at this bigger head and shoulder formation. So this is one that didn't really form, but if we put this in replay mode, I guarantee you a lot of people were looking at this as a head and shoulder formation. Whether they were identifying this as the left shoulder or this one, it doesn't really make a difference. We can go based on this second one right now. So that's your left shoulder, the head, and maybe people were looking at this as a potential right shoulder. So there would have most definitely been individuals looking to trade this to the downside right from there, and maybe a little bit more patient people would have waited for the break of this neckline to the downside, and once it broke the neckline to the downside, they would have looked to trade it. Neither of these scenarios would have been scenarios that would have been profitable. The people who were looking to just catch it at the top of that right shoulder would have actually hit their stop losses, and let me actually take this off replay mode. And the people who were waiting for this neckline, once this started to go higher and higher, they started to realize, hang on, this is not even a head and shoulder anymore, because we've now created a higher point compared to where the left shoulder and where the head is. Even for the people who wanted to stay married to their directional bias and wait for the break of that neckline, it wouldn't have been long-lived. They would have wanted to maybe trade some type of a break and retest of this trend line, which it wouldn't have played out. And based on retail methods of analysis, there wouldn't be many more options on how to enter. Maybe it would have been this resistance or whatever it may be. It doesn't matter. The point is, head and shoulders are not as consistent as we would want it to be. Moving on, this is another example of a head and shoulder. You have the left shoulder, head, right shoulder. This is your neckline, the lowest point between the left shoulder and the head, connected with the lowest point between the head and the right shoulder. And again, people probably would have waited for the break of this neckline. However, even when that took place, even when we started to challenge these previous structure points to the downside, you were still able to see the bullish market coming all the way up. So if anyone took any sell positions around that region, they most definitely would have hit stop loss. Another example of an inverted head and shoulder formation is what we have straight after. This is an example of something that was yet to be created and people would have wanted to trade this. So if people were looking at this live, you would have been able to see left shoulder, head, and they were waiting for this right shoulder to be created for them to be able to trade it to the upside. They would have maybe drawn their necklines over here. People who were a little bit more patient would have waited for the break of that neckline, but that already is a red flag because that's a very steep neckline. By the time we break it, a lot of structure points might actually change and the entire market direction may change. But this is one of the scenarios that people would identify as, hey, over here we've broken structure to the upside, we've got the left shoulder, we've got the head, so now we're waiting for this right shoulder to be created, where people would have put in their Fibonacci tool, for example, from this low to that high, and again maybe waiting for that golden pocket, that golden ratio to then trade this to the upside, only to later on have their stop losses hit, which is what we had over here. You might say, oh, hang on, after that we reversed and we broke the neckline to the upside. Maybe you were able to take some of these trades to the upside from there. Wrong, because by then the head and shoulder is now invalidated. This is not a head and shoulder anymore. If anything, this looks like a Wyckoff accumulation more than any type of head and shoulder formations. So now that we have a better idea of what head and shoulders are, and now that we have a better idea of why sometimes they may be a little bit more inconsistent, what we can do is we can now actually speak about head and shoulders from a little bit more advanced perspective and speak about how we can actually use them in our favor. So what I'm about to go through right now is just going to be the theory behind it. You can actually practice this in your own time for yourself, but a nice way to use head and shoulder for your analysis is to not use it for your analysis, and instead of using head and shoulders, simply think about the actual structure of the market. For example, when you can see a continuous bullish trend, instead of trying to identify head and shoulder formations for your reversal, have patience and identify true breaks of structure and a trending market, and then you can take your trades accordingly. Yes, guaranteed, after that you would be able to see some type of a head and shoulder formation, but that's not really the point here. The point is you're seeing the market from a slightly different perspective. Instead of trying to trade a pattern, you're trading the structure. But a very important point trading structure is, why should the market reverse? Why should it reverse? A lot of the times I have seen that traders expect some type of a trend reversal. Because the market has been trending higher and higher for so long, they just expect it to reverse. And they would take any of the break of structure to the downside as a confirmation of that reversal. And that's a complete wrong way to look at the trending market and look at the actual market phases. My advice to you would be, first find higher time frame trend. So what are we actually looking like on the daily or maybe even weekly time frame? What is the actual trend on the daily and the weekly time frame? And this is not a difficult thing to do, simply because all you have to do is go to the higher time frames and identify what you already know, which is low, high, higher low, higher high, higher low, higher high, so on and so forth. That is where your market structure comes into play. It's as simple as that. In some future videos, we may go into some more advanced market structure. However, a very basic and a very major point for market structure is simply, have we created a new high based on the low that was created in a bullish market? and have we created a new low based on the high that was created in a bearish market. And that might not have made a lot of sense, but as I'm describing it in this scenario, hopefully it will. If you're going to go ahead and identify this as a low, high, higher low, higher high, and now you have the first three major waves within this market structure, you want from there for the market to in a way respect your structure points, create a higher low. However, you're not really able to tell if the market is trending properly if we create a new high based on the previous low that was created. So now we have created a new high based on the previous low that was created. We can pull back, it creates a new low, you call that your higher low. And again, the question is, have we created a new high based on that previous low that was created? These are the questions that you should ask yourself for you to be able to identify the correct market structure. And in a bearish market, it would be the other way. So let's say you can see the high, low, lower, low, and from there you can start to see something like that. Even in this specific scenario, you have to understand that the same thing applies. We've created the high, low, lower high, lower low. So we've got that first three major waves of a trend. Then the question is, based on the previous high that was created, that's a very bad arrow, but you get the idea. Have we created a new low? Yes, we have. Then this pulls back to create a lower high. And again, we would only know this is trending properly if based on the previous high that was created in this case, the market ends up creating a new low. That's how you know the market is trending properly. And this is now a concept that you can apply for your own break of structure. So you don't take any and every random point as your structure points. You look at the major ones, which are the major structure points in the market, and trade based on them. Guaranteed, as you start to come to the lower time frames, you will start to see different trends and different moves in the market. However, this is where you can now start off with the higher time frame trend, daily and weekly. And we want to always trade with the higher time frame picture. Sometimes you will get these massive higher time frame reversals. However, majority of the times we want to be trading continuations. From there on, you can look at the lower time frames, such as the hourly time frames, 1 hour, 2 hour, 4 hour, 8 hour, whatever it may be, for you to then see what is now the trend telling us on the lower time frames. So for example, you've identified your daily time frame and you have seen a bullish trend. You can do the same on the lower time frames, where you can identify structure points now on the lower time frames. But you have to understand, if you're looking for a major reversal, you have to see higher time frame break of structure. So if you're in a daily bullish market, there's no point taking position or swing trades on the bearish side of things if we haven't broken daily structure points to the downside yet. So as you start to study structure more and more, you will be able to see that it's fractal again. In all given time frames, you can see the bullish or bearish structure. However, I don't want you to be too invested in continuously going to the lower time frames, trying to identify the smallest time frame trend and taking trades based on that if the higher time frame is actually disagreeing with you. Connecting this to head and shoulder formations and talking about how we use similar concepts as trading retail methods of analysis to what we do, this is the scenario that I can describe. Imagine if you have a higher time frame, for example, let's say a daily or weekly point of interest, and the market is already bearish, so you have been able to see the continuous bearish move, so it's definitely in your favor. And what you'll see is a higher time frame point of interest, for example, a daily institutional candle or an imbalance or whatever it may be. So now you know that's, for example, the zone that on the higher time frame you want to take trades based on and take this to the downside. However, now you need your lower time frames to confirm and agree with that analysis. So it goes without saying, as this is approaching your zone on the lower time frames, most likely it's going to trend. Most likely it's going to create higher highs and higher lows. Instead of now looking at this from a head and shoulder perspective, try and trade it based on market structure. So instead of looking at it from a head and shoulder perspective, ask yourself, okay, have we broken below, for example, significant structure points for us to be able to trade this to the downside? And as you start to study these more and more and more, maybe you want to even utilize concepts such as Wyckoff schematics. This is something that we've been speaking about for a long time, where you have a higher time frame point of interest and then a lower time frame schematic being formed at that level. Maybe as you're expecting a break of structure to take place, you start to get some type of a distribution schematic, which goes without saying, it makes it much more confirmed to take these trades to the downside. And instead of you now looking for a pattern to form and wait for some type of a left shoulder head and right shoulder, you're expecting the correct structure points to be broken to the downside, and now you know, or you should know, what correct structure points are. I mentioned it very briefly, but probably sometime in maybe January or February, I'll do some market structure videos as well for you to understand them a little bit better. But once you start to see the challenge of major structure points, this is now where you can expect to see some type of a pullback and trade this to the downside, with the difference that you're not trading these pullbacks based on a random Fibonacci level. You would be trading them based on either institutional candles within this range or some type of an even lower time frame distribution schematics being formed over there for you to be able to get better risk to rewards, or for you to then be able to get more quote-unquote sniper entries. This doesn't stop here, by the way. From there you can go to the minute-based time frames as well, or second-based if you want in due time, but I would recommend, as of right now, first get used to identifying the correct direction based on the higher time frames and the hourly time frames, and then start to utilize lower time frame structures. And please understand, if a market breaks structure on the 5-minute time frame, it doesn't necessarily have to break structure on the higher time frames. That's not a thing, and I don't know where this kind of came from, but a lot of people who trade these concepts seem to think that definitely when it breaks structure on the lower time frames, it means it's going to break structure on the higher time frames. On some of the trades that I have posted on this channel, I take the trades sometimes based on lower time frame breaks of structure, but I know the risk. I know that even though this is happening, it might not necessarily break the higher time frame structure. And to be honest with you, majority of the times that I take the trades based on the lower time frame structure breaks is when the higher time frame is in agreement anyway. So the trade is actually a higher time frame bias, and I'm just utilizing lower time frames to get better entries. So now I encourage you to start to look at the market from a structural perspective rather than a head and shoulder formation, and do not think to yourself that circling the structure points is not going to help. Believe me, it does. Believe me, any and every trader who has achieved a lot of success in this industry have started from there, have started from literally circling structure points on the higher time frames and then looking at them on the lower time frames. And the final piece of advice I'll give you is, if you're looking at the structure points on the higher time frames, look at the major structure points. Ask yourself the question, where can you actually see the major trend? Where can you actually see the lows that have resulted in new highs in a bullish market, or the highs that have resulted in new lows in a bearish market, and circle those, and then go to the lower time frames and start to look at the minor structure points as well. Now, there are many other retail concepts that are similar in terms of theory to some institutional concepts, such as break and retest, such as divergence, and in future videos, most definitely we are going to be speaking about them as well. Break and retest more than anything else, because break and retest is one of the biggest concepts that's traded by a lot of people, and it's actually derived from institutional concepts. However, a lot of people don't know how to use it correctly. I've got a lot of plans in terms of the videos that I want to be posting within the first 2 to 3 months of 2021, from hopefully some market structure videos to go in a little bit more depth about them, to other videos about the similarities of retail methods of analysis to institutional concepts. And as mentioned, break and retest most definitely will be a topic of discussion as well. But as of now, I encourage each and every single one of you to think about some of the concepts that you have learned from a retail perspective and start to compare it to the information that you're learning or you have learned in this channel and from other sources, to find the similarities, to see if they are similar in any way, shape or form, and see how looking at it from a slightly different perspective would actually help you increase your winning rate in the financial markets. Not the normal type of video that I post on this channel. We normally do chart breakdowns or maybe some, for example, introductory videos to institutional concepts. Again, I'm using that as a very big umbrella term here. But as you are making the transition, it is important to know about these little details. And as insignificant as the information may seem, these are very important as you are making the transition from retail methods of analysis to institutional concepts. So make sure to subscribe down below if you're new to the channel and press that little bell button for you to be informed whenever there's a new video. As I said, I have a lot of ideas in terms of the videos that I want to be putting out in 2021, so I don't want anyone to be missing out on them. If you got value from the video, press the like button down below. Appreciate everyone's support. But with that being said, let's elevate and let's catch some pips.